Really happy to have Peter Henry back to the best place of all. After a sojourn in the New York City and back, I understand you were here 13 years and then 11 in New York. So it's great that you're back and just the beginning of many good things to come again. So thank you, Peter. But this is a joint paper with Camille Gardner, and it's called The Global Infrastructure Gap, Potential, Perils, and a Framework for Distinction. So it's a great title. But one thing, maybe you could say a little bit about this excellence initiative. We don't know anything about it. If you have any time during your talk, beginning, whatever, and I see you have a colleague who knows a lot about it. Okay.
Yeah.
Thank you.
Thank you, John. It's really.
And we have people who are external, so they're
hello,
part of the group.
All those who are on screen and here in person. It's really terrific to be having the chance to talk to this group. So thank you, John, for that introduction. So as John said, this is a joint work with Camille Gardner, who's a graduate of a program I run called the PhD Excellence Initiative. So just a word about that. The PhD Excellence Initiative is a Sloan Foundation / Hoover funded initiative. It's a post-bac program whose goal is to increase the number of underrepresented U.S. minorities in PhD programs in economics. So Camille Gardner is currently a student at Brown University in her third year of her PhD program. We have in the room Precious Fasakin, who's in the second year of her fellowship, and she's in the midst of waiting to hear from graduate schools. Does work on political economy and African development. So that's the PhD Excellence Initiative. So really thrilled to talk to you today about this paper, The Global Infrastructure Gap. So this paper is motivated by two facts, right? So fact number one is that, and please jump in at any time, ask questions. I'm sure I don't have to say that in a group of economists, but just in case this is a shy group, I'll go ahead and say that. So the first fact is that in poor countries, there are 1.2 billion people who have no electricity, and another billion people who do not live within 2 kilometers of an all-weather, all-season road, as documented by Rosenberg and Fay in their World Bank book of 2019, and also in many other places. And just to give you a sense of the low ratio of infrastructure capital per capita in the developing world relative to the advanced world, Latin America is roughly 1/4 the infrastructure capital per capita of North America. Emerging Asia has 1/5 the infrastructure capital per capita of advanced Asia. And the 48 countries of sub-Saharan Africa produce about as much electricity as all of Spain. So this is a fact, right? There's a lot less infrastructure services in poor countries. Fact number two that motivates the paper is that in April 2015, the World Bank claimed that by moving from billions to trillions in infrastructure investment in poor countries, that rich country private capital could do three things. One, they could close the infrastructure services gap, which is an allusion to this sort of just shortage of infrastructure capital per capita that I mentioned before. Two, achieve the sustainable development goals. So just think about the energy transition that's currently underway as part of the SDGs. And three, make money, right? So the World Bank makes this threefold claim, and they kind of launched this call to action from billions to trillions. And in addition to the World Bank, the IMF, and the various development banks were part of this initiative, and they issued a communique. Okay, so those are the two facts that motivate the paper. So we want to ask a very simple question: is it true that poor countries have widespread potential for publicly efficient and privately profitable investment in infrastructure? Right? Because if you think of the World Bank's claim, the World Bank's claim really boils down to this. You can do well and do good by moving more infrastructure investment into poor countries. Okay? So this is the question we try to answer in this paper. Okay? So if you look out in the world and see what other people think about if the answer to this question is, the answer is yes. If you look at the McKinsey Global Institute. So in 2016, the McKinsey Global Institute, this is sort of what McKinsey does best in some ways. They sort of seized on this communique that the World Bank issued in 2015 and launched a report, which basically coined this phrase, the infrastructure gap. So what did McKinsey do? McKinsey basically said the following thing. If we look at projections of global GDP growth, which at the time were roughly something like 3.5% per year or something, and do some, let's call them back of the envelope calculations to estimate how much infrastructure would be needed, just taking that as given, and then look at the following number, so you can actually get projections of global infrastructure spending. I forget the exact name of the publication. It's cited someplace in the paper. And so they just aggregated up kind of what projected infrastructure spending was versus kind of what it would need to be in order to achieve the 3.5% growth rate, and said, oh, the second number, what's projected on infrastructure spending, is shy of what's needed by about $1 trillion a year. And they said there's $1 trillion a year infrastructure investment gap. Lots of challenges with that, which I'm going to talk about. But in this room, I think it's pretty obvious what the challenges are. But to the broader world, yes, there's a $1 trillion infrastructure gap. John, and then some person next.
Yes.
In that question, are we holding constant or not the country's political and economic institutions? Because I can easily see that if India could import American institutions, now it's profitable. There's no reason they shouldn't look like Texas. And if they don't, it's not profitable for the obvious reasons it's not profitable.
Yeah. So when we actually look at the data, we're gonna look at some data on estimates of the social rate of return to infrastructure. Those estimates we take from, kind of shockingly, the only paper we could find that exists that's actually done this exercise. And the shorter answer is that it's a paper was written by David Canning, who's an economist at the Harvard School of Public Health, with a deceased co-author. And in their paper, they try to do what you just suggested. They try to estimate essentially the elasticity of output with respect to infrastructure, taking into consideration levels of human capital and taking implicitly institutions as given. So basically, they kind of control for the kind of the stuff that Luke was just worried about, and say, given all that, kind of what's the best we can do in terms of estimating the elasticities. And I'm going to talk about those numbers. They produce some numbers, which I think actually largely reflect your concern, which is that infrastructure returns aren't so high everywhere. That's really the punchline. But I'm going to.
There's a reason for.
Yeah. So I'm going to get to that. Yes.
I had a similar follow-up question. There was, do you think about potential in terms of sheer expenditure differential in expenditure and infrastructure, or you're thinking about net rate of returns? But then you have to take into account the various vintages and the profitability of the vintages and the feasibility of their operation. I looked at Latin American countries, and a lot of very advanced equipment for farming that has been heavily subsidized by the World Bank ended up not being used because spare replacement parts were not available. A lot of the farming workers were not able to operate them, so on and so forth. So how do you factor these considerations in your calculations?
So hold that thought until I tell you about the data, right? So I think both your comment and John's comment are going to reinforce, I don't want to say skepticism, but we're gonna issue the framework that we produce and the data that we feed through it are going to give us a very kind of cautionary tale, caution, saying that the World Bank really has overstated the case here. And our message is that we're going to show you why that's the case. I think most importantly, what we're going to do is actually give a framework for actually think about how would you even approach this question, right? But I think both your question and John's question are going to lean in the direction of reinforcing our message of, frankly, conservatism.
Unless you're looking for bounds, like an upper and a lower bound on potential returns, and
Yep,
and then
so-
it's informative already.
Yeah, so we're gonna get there. So hold that thought. So McKinsey, told you about McKinsey. Not to be outdone, the JP Morgan Development Finance Institute, just before the pandemic hit, JP Morgan announced and so launched this development finance with the idea in mind of, you guessed it, kind of filling this global infrastructure gap. And most recently, the White House in June of 2022 issued, you can find the memorandum, it's on the website, White House website, it's a partnership for global infrastructure investment, which is, again, kind of quotes this global infrastructure gap and is kind of a follow-up on the Build Back Better World initiative from 2021, which is, again, geared at essentially trying to sort of find a counterbalance to China's kind of Belt and Road initiative. And this is, by the way, it's not just the Biden White House. In the Trump White House, I attended a virtual seminar in December of 2020 as they were on their way out, quoting the same kind of global infrastructure gap numbers. So my point here is that there are a lot of serious institutions, from the White House to McKinsey Global Institute to people who are actually allocating capital, private capital, that are using this framework as a way of driving their thinking about this question.
So, I mean, in some sense, the way it's stated, you say, what is wrong with this? The framework is people are where they are. Yes, there's different forms of government, different systems, but yes, they can catch up. Otherwise, why do foreign aid at all? It seems there's the whole presumption here is a yes.
So, right, so you're, segue, John. Right? So what are the concerns? So the concerns are that the notions of a global infrastructure gap and needed investment bear an unfortunate similarity to the financing gap, which I'm sure the few folks in the room will remember this idea of the financing gap of Hare and Domar, right? So just a kind of quick reminder, like the MGI conception, the Hare-Domar model basically asserts that, let's say there's a desired target level of growth you want to hit. Make up the number 5%. I can see Nick Hope smiling. I'm sure he remembers this, right? The idea is that, okay, you then say, given savings, national savings, target investment applies a financing gap equal to the difference between the two quantities, and kind of armed with this framework, this is was kind of the MO of the World Bank in the 1950s, right? So rich countries sought to help poor countries grow by filling the financing gap, right? And to quote Bill Easterly, they failed, right? They failed because they didn't ask the question, which I'm sure almost everyone in the room is asking. Well, you have to ask the question, whether filling this needed investment gap would actually correct some market failure, incentivize production, given institutions, as John mentioned, and so forth, incentivize production, and endogenously raise incomes. So all we're going to do in this paper is just we're going to take equilibrium seriously. But before I do that, let me just a little more motivation in the data to say, okay, well, more broadly, why should we care? We should care because if you think about whether it's the Partnership for Global Infrastructure Investment, China's Belt and Road Initiative, or all the thinking that's currently going on about financing this green transition and so forth, there are big opportunities, but there's also opportunity for peril. And just as a reminder, what's the potential peril? This is so pay attention to the green line and the blue line. The blue line is the average annual growth rate across all emerging economies of the public growth in the stock of public capital. So think of it as a proxy for infrastructure. These numbers come from the IMF. And the green line is the annual percentage growth rate of productivity. Again, average across all countries. And this is a very simple point was if you look at the developing world in the 1970s, there was a rapid acceleration of investment in public capital that coincided with, if you remember, I remember teaching about the third world debt crisis. There was an oil surplus in the 70s, got recycled. There's lots of capital that flowed to developing countries. A lot of it got invested in public capital, and the productivity gains that we'd like to see coming from infrastructure didn't happen, right? And we know the kind of the outcome of that story was the third world debt crisis. The point is, if we kind of go back to, hi John, nice to see you. If you go back to this kind of thinking again, there's a potential for basically deja vu all over again, right? And so I'm thinking here, Ken Rogoff is this piece on the third world debt crisis. I've mentioned Easterly. I think very importantly though, even before COVID hit, so if you think about the current environment, so Ghana's defaulted on its debt. Zambia defaulted, I think, in 2020 or 2021. You may know about the case of Sri Lanka having this Hambantota port that was financed by the Chinese, got seized because Sri Lankans couldn't service the debt. Even before COVID hit, Landry Signe, who's at Brookings, Carmen Reinhardt and co-authors, and Gallagher and Ray, who run this Center on Chinese Capital Flows in the Developing World at Boston University, were warning about high debt in poor countries and potential for default. And so we're seeing that play out. And it's not just, the point is that this is not just a COVID effect. The seeds for this potential kind of deja vu all over again were planted even before COVID hit. So, and again, kind of just sort of this naive sort of gap thinking is at the root of at least some of it. Okay?
Peter, do you think the answer to your big question of whether this investment can be profitable and also good for the receiving country, does it depend on, is it the answer different if the funding is coming from China versus the West?
I think the answer is yes, and here's why. I think that's exactly the right question. So it all depends on, so do you have a model in your head of why it is you're channeling capital, right? So if we kind of think back to kind of the rationale behind the Bretton Woods institutions, all of them, the World Bank, the IMF, even the WTO, right, is very simple. We want to think about a world in which capital flows from country X to country Y and Z and every letter in between are motivated by trying to maximize global welfare, right? And as a proxy for that, think about maximizing global growth, okay? If the model that you have in your head for allocating capital to poor countries is politically driven, then you have to think for a very long time to realize you probably are going to get different outcomes. And so we're not saying this, we say this sort of very politely in the paper. But if you're not being driven by this model of maximizing global welfare, it's not surprising that you're going to have these kinds of outcomes. And so part of the motivation is if we actually want to think about how to bring them out, kind of welfare maximizing outcomes, you need some leadership to sort of say this is the way in which we should be thinking about global capital flows, particularly with respect to infrastructure. So the paper's not a normative paper, but that normative message is lurking, not too far from the surface, John.
You mentioned impediments, which you need to, George turns to Milton and says, Milton, there's a $20 bill on the sidewalk. Milton says it couldn't be that the market would pick it up. So the claim that it is, it's high marginal product and profitable and privately profitable, then you kind of got to ask, why do we have to do this? Why hasn't it happened?
Yes. So the first question is, are there instances, are there places in the world where that claim is actually true? And then
what's the barrier?
Yeah. And then in the section 6, we have section 6 of the paper. I should say I'm not going to talk about all the paper today because it's a long paper. It's forthcoming in the JEL. But I just want to hit the high points so you can kind of go back and read what really particularly interests you. Section 6 of the paper is called Frozen Capital, which is basically kind of getting at this point, John, which is if you think about those places of the world where the opportunities do exist, but they're not actually being taken advantage of. Why is that? But let me say a little bit more about that when we get there. All right, so I've given you kind of most of the, you only have most of the message of the paper, but let me just sort of to walk you through a little bit of the logic. So this paper can do something very, very straightforward. And we're gonna introduce a simple equilibrium framework that distinguishes those four countries in which the bank's threefold claim is tenable from those where it is not. So John Taylor and I were talking about Econ 1 before everyone walked in, and this is really, it's sort of Econ 1. As best as we can tell from looking at the literature, just some basic kind of first principles that haven't been applied to this set of questions, and so we're gonna do that in this paper. And we're gonna call our framework the dual hurdle framework, and we're gonna call it the dual hurdle framework, as you'll see in a second, because we're gonna ask two questions about hurdle rates. We're gonna say, what's the hurdle rate for thinking about efficient investment in infrastructure from a poor country's point of view, in terms of whether you invested $1 in private capital versus public capital. So it's gonna be one hurdle rate. And then we're gonna think about a second hurdle rate, which is to say, if you're pension fund or investment manager in rich countries, and you're thinking about allocating $1 of savings versus, in some place in the US privately, versus investing in public capital in the developing world, there's going to be another hurdle rate that you're going to have to consider. And so once we put in place these two dual hurdles, we're going to see that it clarifies thinking pretty quickly about whether the World Bank's right or wrong. And the main kind of message that comes out is that the dual hurdle provides a practical tool for setting infrastructure priorities. It's going to tell us where the World Bank's claim is true, where it isn't true. But more generally, this way of just thinking about hurdle rates is going to apply within countries to think about, you could use it to think about sort of, roads versus electricity, schools versus roads. It's basically just provides discipline for thinking about where investments in infrastructure are going to be socially efficient versus not socially efficient, and applies within countries as well as it does to the kind of the cross-country analysis we're going to do here. And I think the most important message, really, or finding that comes out of this paper is the kind of paucity of data that's publicly available right now for actually applying the dual hurdle framework. So in other words, the World Bank makes this claim in 2015 about going from billions to trillions in infrastructure. And they do it, as we're going to see, as I take you through the paper, on the basis of no data whatsoever, to be frank. It turns out the World Bank, when they made this claim, they had actually commissioned a paper in the year 2000 that estimated social rates of return across countries, which you could have used to apply the dual hurdle framework. We actually do that. But the World Bank doesn't reference this paper at all. They make no reference to any social rates of return, which to us is kind of stunning, frankly. But most importantly, given that these are knowable facts, right? I didn't get your name. Elena's point, estimating social rates of return really depends on assumptions you make about things like maintenance, and the social rates of return that were estimated in this World Bank white paper in 2000 were based on data from 1985. So these data are really old, but the World Bank should be in the business of basically updating this data, independently validating it, so that people can actually have information on which to sort of have a serious debate about what these returns look like, how big are the gaps in returns between rich and poor countries, and begin to think about whether these are opportunities worth pursuing. But without the data, it's really a conversation in the dark. Yes, Peter, and then Elena, and then Steve.
And
Someone online as well.
yeah,
Michael.
Go ahead, Michael. Well, sorry.
Yeah.
All right, Michael, then Peter, then we'll come back around. Go ahead,
Yeah.
Michael.
so there's a lot of evidence in advanced economies that rates of return on infrastructure are very modest. The CBO estimates they're well below
Yep.
private rates of return, number one. Number two, that the highest rates of return are repair and maintenance. That makes more sense perhaps in a more developed infrastructure
Yep.
economy, that diminishing returns are set in. There's not a lot of extra interstate highway you can build. We're not going to build a highway to Hawaii. So in any event, but then there are all the political economy complexities in the United States, which I'm sure are more extreme in many developing countries. Regional, tribal, political differences, graft, corruption, exchange rate constraints, which drive wedges between, in cost benefit analyses, et cetera. And so I'm just wondering if we're thinking about the basic idea of the rates of return being relatively low in advanced economies, but perhaps being potentially somewhat high, at least if they can be organized and implemented in a way that isn't overly politicized, that drains away the social returns. I'm wondering what we can learn from the history of infrastructure development in advanced economies that might be applicable, if not the current events, that might be applicable and things to avoid. And are you looking at those kinds of things? And is that a potential valuable place to look for insights into currently developing economies?
The answer to your question is yes, Michael. The point about the modest rates of return on infrastructure in advanced economies is central to this picture that I'm about to describe, right? And so to your point, there's a paper by John Farrell in the AER in the early 2000s, which basically demonstrated what you just said, which is that building an interstate highway system generated large social benefits. But subsequent to building the interstate highway system, there's not much evidence to suggest that there's continuing kind of growth benefits from investing in roads. And more generally, what we find when we actually look at the data that was produced on social rates of return by Canning and Benathan is that in general, the rate of return on on infrastructure, on roads in particular, in advanced economies is generally below the rate of return on private capital. So why that matters is that when you're thinking about the incentive for capital to flow from rich to poor countries, basically the comparison between, the relevant benchmark, the binding constraints for private investors in rich countries is not whether they should be investing in public capital in rich countries, because the rate of return is generally lower than the return of the S&P 500. It's whether the rate of return on public capital in poor countries exceeds the rate of return on private capital in rich countries. So that's sort of point number one. I'm going to talk about that analytically in a second. Point number two, your question about are there things we can learn about the political economy of infrastructure investment in rich countries? I think it's a great point. We don't have a lot to say about that in this paper, but we think that our findings, which suggest that there are some opportunities potentially in poor countries, we got to be really careful about it. And the way you want to think about how to actually bring those to fruition, I think probably can be informed by what's happening in rich countries. Peter.
When you talk about the dual hurdle test, are you going to put in place a mapping between these hurdles and then the potential frictions that we think might be responsible for the reason for which there isn't as much capital flows? And
Yeah, first I'm going to just talk about the hurdles.
okay, I'll wait then.
And then in the section, I'll allude to the section of frozen capital is all about, this is John's question. If there are big gaps, why don't we see the flows? And that's going to be, I'll come to that. I think Elena was next, and I'm losing, and then Steve, and then Russ.
We're thinking in marginal terms about rate of returns, but I'm thinking about the cost structure. Like imagine I'm trivializing the infrastructure choice problem as a capital adjustment problem.
Mm-hmm.
And I'm thinking about the standard SSS shape of Canaro, etc.
Mm-hmm.
And so I'm thinking, well, it could be that the minimal feasible, so to speak, meaning privately optimal, not thinking about network effects, investment in infrastructure capacity is high enough for reasonable return to kick in. that it may be too much, so to speak, for the prototypical underdeveloped country to be able to do so, to convince international institutions to support it, etc. So it could be just a very simple story that you need a minimal capacity to really invest efficiently, and at that level, the rate of return calculation kicks in. And so I wonder if you have any sense that this story, standard story of non-concavities or local convexities could
I
be.
don't think we're able to speak directly to that question in the paper, but I think the orders of magnitude that we're going to show, I think will be illustrative. So a little more patience. We're going
No,
to.
so I'm sorry. What do you think about the work of Dave Donaldson and others at MIT? In fact, it shows you that electrification, when infrastructure doesn't require a lot of, well, that requires some capacity, but there are clearly vast economy of scale to support it. That's where some of this investment have been most
Yeah,
successful.
we allude to
Okay.
today's work in the paper. And yeah, David does it for Indian railroads.
Mhm.
And we're trying to do it. We're going to do it for. We're going to look at this question for basically 53 countries.
Okay.
So that's, but through a framework. Yeah, Steve.
It would be something to replicate Donaldson's work for 53 countries.
No, we're not
I
replicating.
know, I'm just saying.
Yeah.
Can you just clarify what's in your concept of the social return? So is it just things that ultimately that show up in GDP in the near and
Yes.
medium term? So
Yes.
it doesn't include, for example, if we build a road network in a rural, underdeveloped region with no roads, that there's going to presumably be some positive benefits on health outcomes, especially for children, and maybe better education. Those are things that will manifest themselves in GDP way down the road.
Yes.
So that's not in the
That's right.
social return.
That's right.
Okay.
That's right.
The way you're.
Right. And so one critique, for instance, that Valerie Ramey had of the paper, when I sent it to her, is if you think about like rural electrification, the one thing we're going to find is that the results for electricity are much weaker than they are for roads. And sorry, we just have no way of saying anything about it with what we've got. But her point is don't overstate how low the returns might be, because to your point, if there are things that don't show up in GDP,
Right.
or if there's a particularly long lag between, let's say, electrification and and GDP benefits, you're missing that, and that's absolutely true.
Okay.
So
I mean, do we have high quality evidence on how building a road network affects child mortality, for example?
I've not seen those. I've not seen those.
Okay.
I've not seen those yet. So I guess so I think the way to think about your comment is to say, so what are the reasons to be skeptical of our conservatism, right? So if you believe that the externalities of infrastructure are understated, and they're more generally the estimates that are trying to basically estimates of elasticity of GDP, the standard thing, are missing important other factors, then yeah, you should be skeptical of what we're saying. So we're really tying our hands to just the production function, and so
Okay.
and letting Canningham and Nathan do all their econometric tricks to sort of get us the best conservative estimates we could find of kind of social rates of return in the strictest kind of old kind of Harburger kind of sense, right? And saying, what do we see? And then we have a section in the paper where we kind of look at kind of Jones and Klenow and others to say how wide are the confidence intervals around these kinds of estimates, and other messages. Be really careful. There's a lot of variation in the data. Right. And so we think that kind of reinforces our message of conservatism, but totally open to the fact that you might say, you guys are maybe you're being too conservative.
Health shows up in GDP pretty fast in poor countries.
Yeah.
A lot of people don't work because they're sick. No,
Yeah.
but I'm thinking about.
Could I
child
ask you
mortality rates,
one
things like that.
question?
That's not
How
gonna
much
show
of
up quickly.
infrastructure is auto related and truck related? It's probably huge, isn't it?
Yes. So
Isn't there a question whether that's even going to be replicated?
replicated in what sense, John?
I can think about 10 or 20 years. And you can have easily, auto is a sort of a complex machine that's actually only used 4% of the time.
Right.
And you can have a taxi service activated by cell phone or whatever in local areas. And if you're going to go on a vacation, you lease a car, and you could cut way back on the whole entire infrastructure. If you think of 1.4 billion people in India
Right.
and putting a road structure in there, it's going to be impossible.
I see. That's a good question. So the best I can do in answering your question is the estimates of the rates of return that we have in the paper. There are two types of infrastructure that Koenig and Nathan did the estimates on: electricity and roads. And so I don't think that their estimates are going to speak very well to the future, if I can interpret the spirit of your question. But one of the things that we say in the paper is that taking the estimates that we have as given, and it turns out there's a lot of evidence that roads are the much higher return project in general in the developing world. But to your point, one thing we sort of say in here, we got to be very careful, because you're trying to think about kind of the roads you might build in the future, especially given that the data we have are from 1985. Just when these estimates were done. Those estimates are probably quite different than the rates of return you could get today. And more generally, yesterday's roads may not be tomorrow's kind of transportation network. So if you're thinking about how you'd want to think about the future, the point we make in the paper is there's some very interesting work by a guy named Solly Angel, who's at NYU, who works on cities. And his point is that when you think about roads, right, the biggest return you can actually probably get on road infrastructure in developing countries is just laying a grid. Why do I say that? So it turns out that because of your point, like we don't have a good sense of exactly whether we're going to have electric cars driving on roads, or what the technology, how many cars we're going to have. But we do know that the grid that was laid in New York City made it pretty productive place, because we've got right angles, and there's urban space set off from kind of green space and so forth. And so if you think about like Ethiopia, right, which is going to have 30 cities emerging over the course of the next 15 to 20 years, what you want to do is, in anticipation of future urban development, basically lay down a grid. And that may be and just so having that grid laid out may be the highest return for roads you can actually use, as opposed to actually deciding whether it's going to be asphalt or cement or so forth. So I'd say that's a pretty subtle answer to your question, but that's one of the things that really, when you actually kind of step back and look at this framework and see what's going on in these places, you begin to really get a sense of how complicated the question is. And what you really want to do in that case is you want to maximize your ability to have option value in the future of how you'd actually would build the road, given that you don't know what technology is going to look like. So I kind of got ahead of myself, but it's a great question. Yeah, it's a great question. Okay. Oh, there was one other.
You can go ahead.
Okay, so let me talk about the framework.
In the last 20
Okay, so
All questions.
so let's think. Let's start with kind of a thing about Lucas's 1990 AER paper, which basically says capitalism. Why does the capital flow from rich to poor countries? And when you think about infrastructure, you got to ask, where does Lucas fit in all this? Well, it turns out that when Lucas wrote his paper in 1990, sort of a couple of points to make. One, there were a lot of restrictions on capital flows in 1990. And one of the hypotheses that Lucas put forth in this paper is why capital doesn't flow from rich poor countries, which he kind of was a little bit dismissive about, was actually that there are barriers to capital flows. So it turns out, when Lucas published this paper in 1990, probably wrote it in 1989. Shortly after Lucas published that paper, guess what? Emerging economies lifted restrictions on capital inflows to developing countries. And it turns out a lot of capital did actually flow in to emerging economies, into their stock markets in particular, right? So Lucas wasn't completely right. There were some significant gaps between the return of private capital in rich and poor countries. But the biggest point to remember today is that those returns have largely, on private capital, have largely been arbitraged away. And that's sort of, I wrote my graduate school thesis about that. And if you actually look at the data, returns on equity, portfolio equity capital are pretty close now between the rich and poor countries. But the important point about infrastructure, which is follows from this paper by Lowe and co-authors, is that whereas the returns on private capital between rich and poor countries have largely converged, right? So Lucas is now right about that point, right? And this is what the Caselli and others have made in their paper on the return to capital. The potential welfare gains from private rich capital flowing to public poor capital are roughly 4.8 times larger than those from private rich to private poor. So in other words, this is going back to Michael Boskin's point, because the rate of return on capital, on public capital in rich countries is so modest, there's really not much of an incentive for private capital in rich countries to invest in public capital in rich countries. But because there are large differentials, potentially, between public poor capital and private rich capital, that's what we really need to think about. And so what this diagram kind of outlines is that in order to think about this question of whether there are significant welfare gains for private capital flowing from rich countries to public capital in poor countries, Lucas's framework doesn't give you enough richness, because in Lucas's world, we just have a rich country to poor country and one type of capital K. So you can't really speak to this question of private versus public capital. So all we do in this diagram is just sort of lay out, when you actually allow there to be kind of two kinds of capital in two countries, there are a lot of permutations you need to think about. Bottom line is the only one that really, there are really two margins that really are binding for the question we want to answer for the World Bank, and that is on number one, the question of whether our private poor is greater than our public poor, or sorry, whether our public poor is greater than our private poor. So what do we mean by our public poor? Our public poor is the rate of return on infrastructure in poor countries. Our private poor is the rate of return on private capital in poor countries. So if, not surprisingly, if the rate of return on public poor capital exceeds the rate of return on private poor capital, then from a welfare maximizing social planner's point of view, it makes sense to allocate the marginal dollar.
Just to make sure I'm not losing the thread here.
Okay.
The statement on the slide is predicated on the view, which I'm not arguing with, but it's predicated on the view that $1's worth of extra GDP in a poor country has the same weight in the social planner's utility function as
That's right.
$1's worth of GDP in rich countries.
That's right.
So that's an important maintained assumption, which makes perfect sense if you're looking at, rates of return and where capital will flow.
Yep.
You may make a very different assumption when it comes to foreign aid decisions, for example.
Yes. Yeah. And so we're gonna. Yes.
Peter, some private capital, a fair amount, in infrastructure is a byproduct of private, for example, energy exploration and development. Companies build complete railroads into the interior of Africa, because et cetera. So I'm wondering how you think of that relative to, some portfolio manager with an international unit.
Right.
Should we just lump them together, or should we distinguish that? And many of those countries either are for their own domestic workforce requirements or for things imposed by the government, building schools, hospitals, stuff like that. So,
Yeah. So let me come back to that question, Michael, because that gets to the point about how do we think about different kinds of infrastructure priorities.
okay.
And I think our framework is going to have something to say about how you want to rank order those. But let me just
I would take a moratorium on questions. Let you talk a little bit.
Okay.
All right. Sorry.
No, it's a good
I'm going to be hopping
question.
on and off. I've got to take one quick call. So if I missed your
Okay.
comment, I'll catch up later.
Got it. Okay, so taking Steve's point about the social planner, it's a social planner. You're putting equal weight on growth everywhere, and just trying to maximize overall growth. So talk about comparison number one. The other relevant comparison is going to be number two, right? The question of whether our public poor is greater than our private rich. We've talked about that. Okay, so those are the two relevant hurdle rates, and with those relevant hurdle rates, we can construct this very simple picture, just to ask the question: where is it publicly efficient and privately profitable to invest in infrastructure? Okay, so let me just describe what's on the axis here. So on the x-axis, we have the ratio of the rate of return on infrastructure, Rx, in the poor country. So that's our public poor, to the rate of return on private capital in the poor country. That's RK. That's so the company that's our private poor, right? And so what the logic just says is that if the ratio of the rate of return on infrastructure, if the ratio of our public poor to our private poor is greater than 1, it's sufficient to invest in infrastructure in the poor country. So that says the basic. So if you look at the vertical dashed line at 1, says that if you're to the right of that dashed line, it's efficient to invest in infrastructure in the poor country, from the point of view of a social planner in the poor country. Okay? And if we're trying to answer the world, so that answers the question about sort of, is it publicly efficient from the perspective of the poor country? Now, if we want to ask the question, will there be any incentive for private capital to flow from rich countries into the poor country to invest in infrastructure? And I want to be very clear, this is a necessary but not sufficient condition for private capital to flow. But from the social welfare planner's point of view, the answer to that question is yes, if our public poor is greater than our private rich. So on the y-axis, we have the ratio of our public poor to our private rich. And so the horizontal dashed line at 1 that cuts across the y-axis at 1 says if that ratio is above 1, it's efficient to invest in infrastructure in the poor country for a private rich country capital point of view. And so what the dual hurdle framework just says is that the world kind of breaks into 4 quadrants when you just apply these very simple kind of equilibrium conditions, right? And so countries, so for a given type of infrastructure, let's say roads, okay? If it's the case that for roads in Kenya, the relative returns put us in quadrant 1, then Kenya sort of satisfies kind of the World Bank's claim. Okay, and in the case of quadrant 2, it's not the case. Quadrant 3, not the case. Quadrant 4, not the case. I'll just briefly say in quadrant 2, someone asked the question about foreign aid. Quadrant 2 is countries that fall into quadrant 2. And by the way, in our sample of 53 countries I'm going to talk about, there's only one country that falls into quadrant 1, starting in quadrant 2. And quadrant 2 is a quadrant where basically you can make a case for foreign aid, right? Where basically you've got domestic efficiency, but no incentive for private capital from rich countries to flow into the country. Okay. So what we're going to do in this paper.
I No question. I just want to clarify.
Yes,
Private capital goes in when the private rate of return is positive, but I think you're talking about the all-in social rate of return.
yes, very, very important distinction. So we said, take the perspective of the social planner and just say, where would it be kind of socially efficient from a kind of global welfare point of view?
So that's going to include all the externalities and all the other
Yep.
stuff.
And so, yeah, exactly. So we're thinking of this as the most basic necessary condition for the World Bank's claims to be true. Because if the public return in poor countries doesn't exceed the private return in rich countries, game over. Yeah, exactly. You're exactly right.
Total public
Yes.
return, and even private capital can have externalities.
Correct. Correct.
That's-
Correct. All right. So what are we going to do?
Also modular risk, I'm thinking about the return differential in terms of not like equity return puzzle.
Yeah. So the way to think of it. So again, we're not saying anything about risk yet. We just want to say, we just want to take the data that are out there, put them through the dual hurdle framework, and say, where do we fall? Which countries actually fall? Do any countries fall into quadrant one? And then, what I'm going to do at the very end here, I'm going to talk about how you think about risk adjustment.
I see.
Okay, because going back to John's point, if it's the case, if the difference between the social rate of return on public capital in Kenya is, only 100 basis points higher than the private return in the U.S., given all the risks that we've talked about in institutions and political factors, there's that necessary condition is clearly not going to be enough in order to get
You're
capital.
going to give us the data.
Yes, let me give you the data. Okay, so let's start with the data. All right, so we got this. We have a framework, and we just asked the question: okay, what data do we actually have on social rates of return? Turns out, shockingly, I'd love to hear if someone's aware of other estimates, but the only systematic estimates we found were this paper by Koenig and Benith that was commissioned by the World Bank. They do it for 53 countries. Social rates of return on paved roads and electricity generating capacity. So 2 types of infrastructure. They also compute the rates of return on all capital. They do the same data for 16 rich countries. And a big caution, Elena mentioned this issue about costs. They can only do the estimates for 1985 because that's the year in which they've got cost estimates for building roads and building electricity grids. And obviously costs have changed since 1985. Technology's changed. Lots of things have changed. So what we're saying is taking the data is given, but just see if the World Bank had even bothered to actually look at their own data, what would they have found if they applied this framework?
This isn't data. I mean, how do you estimate the social
Yes.
return of a road in Bangladesh?
Yes. So Koenig and Nathan have a whole paper on how they do this. So basically, what you're trying to just very quickly. I'm not going to do it justice in 30 seconds, but you're trying to estimate the elasticity of output with respect to infrastructure, controlling for the level of human capital, the quantity of capital, and controlling for reverse causality and a whole range of other things that are.
Do they look across regions in Bangladesh, or how do they even begin to answer this question?
Yeah, so I refer to their paper. But it's an aggregate number. So they come up with one number for roads and one number for electricity for every country. So already you're talking about pretty heroic estimates, right? But there's an industry in doing this. They're careful about it, and we have a lot of references in the paper to say why we think this is reasonable to take their work as given. Okay, so 26 poor countries have data on roads, 4 data on electricity. So basically, that gives us 75 country infrastructure return observations of rho x k, rho x k star, and we just confront these data with the dual hurdle framework. Just plug them in and just sort of see what do you see. So here's the bottom line: in comparison with the World Bank communique, the joint prevalence of efficient and profitable opportunities is modest. Right. So 21 out of 53 countries in the sample did not clear the dual hurdles for either roads or electricity. right? So roughly 40% of the countries there are no quadrant one opportunities in either type of infrastructure. Of the 32 countries that with projects that cleared the dual hurdles, only roughly a fourth of the 7 cleared the dual hurdles in both roads and electricity. So kind of the first order message is that quadrant one opportunities are not nearly as plentiful as the World Bank would have you believe, or would like us to think. And the reality that less than 1/7 of the countries presented a data-driven case for publicly efficient, privately, actually socially privately profitable, it was just a mouthful, I didn't put socially privately profitable, investment raises questions about the wisdom of billions to trillions 3 decades later. In other words, the World Bank issued this communique in 2015 without even having looked at these data, which are less sanguine than their communique. So let me tell you just a little bit about orders of magnitude. All right, and you can read about it in the paper, but of the 75 observations, there were 39 quadrant one opportunities, 21 for roads, 18 for electricity. They were spread across 32 countries. Importantly, of the 21 quadrant one observations in roads, the mean return was 10.2 times larger than the corresponding return on rich country capital. So in other words, it gets subject to how confident you are in the point estimates of these things, which you shouldn't be too confident, because as we've been kind of talking about, and we have a whole section of the paper that sort of looks at, how the heterogeneity in these things. But just as a point of illustration, the point is that where there are quadrant one opportunities, the differential can actually be quite large, right? So it's 10.2 times as large. The median is about 6. For electricity, as I was saying before, the differentials are much smaller, about 2.2 times larger. Okay? So let me say a little more about orders of magnitude. So how do we think about these orders?
Units question. So I could see a problem that Bangladesh is so poor that building a road, it could double their GDP, and that's worth about $10. And so building another road in Palo Alto, which raises our GDP by 2%, generates a whole lot more money. Is that some of the units question?
Yeah, except that you also building the road in Palo Alto is a lot more expensive, right? So that's presumably that comes out in the rates of return. But I think also an important point about your question, though, if you kind of go back to go back to this estimate that Lowe and others produced, right? So what I didn't mention is that in their welfare calculation, they show that if the rates of return on public capital equalized across countries, that world GDP would be about 9% higher. And your question's relevant there because world GDP would be 9% higher, but that's world GDP, which is heavily skewed towards the rich countries, right? So in poor countries, the delta, right, relative to their baseline is probably quite large.
The thing you ruled off the table, which is where in the world do these numbers come from? Or, is the problem that if nobody has a car, building a road isn't going to do you any good?
Yes.
Is that the fundamental phenomenon?
Yeah. Yeah, and that is the reason why. And again, we have more discussions in the paper. You got to be really careful about thinking about these infrastructure return estimates, right? And implicitly, Koenig and Mather are picking that up in their estimates, right? Because if you're adding a lot of because they base these estimates on kind of incremental the changes in kind of the number of kilometers of paved roads, and they're looking at kind of the impact on GDP, right? And so if, to your point, no one's got a car, right? Or the institutions are just so poor that
bandits go on the road.
Bandits go on the road, right?
Right.
Beautiful
roads.
right.
Whoops, there's bandits every 5 miles.
Then you're not. Then you won't see any impact on GDP, right? And so implicitly, it's picked up in their estimates, and that's why, even though having said that, the road numbers are more promising than electricity numbers, But yes, that's the whole point of doing these elasticity calculations and getting these numbers. But let me say, before taking some more questions, let me say a word about these orders of magnitude and why we think this is a useful way of approaching the question. So the 10x numbers that I mentioned before for roads, where you can think of that as the excess return on roads relative to the Koenig estimate of the return on private capital in rich countries. Another way to think about this is to say, okay, let's think about the size of the excess return on roads relative to the excess return that existed on emerging market equity when these countries were actually closed off to foreign investment, which is something I've thought a lot about. So if you looked in 1985, when countries didn't really allow foreign investment in portfolio equity, the excess return on emerging stock markets, or sorry, the expected return is measured by essentially the earnings price ratio, was about 1.7 or 1.5 times as large as the expected return on the S&P 500. All right, and so what do we know? We know that once liberalization took place and we allowed, companies like Dodge and Koch and others to invest in emerging market equity, right? That 1.5x differential largely went away. And that 1.5x differential, most importantly, that was large enough to basically fuel almost $1 trillion industry now called emerging market stocks. By comparison, the excess return on roads is about 7 times as big. So when you're in quadrant one, so no, they're not ubiquitous excess return opportunities in roads in poor countries, as the World Bank has us believe. But where they did exist, they were pretty darn big. And they were much bigger than the returns that were enough to generate this new industry called emerging market equities stocks. So that's just to give you a sense of what's potentially at stake. And the reason why I think this alternative order of magnitude comparison is useful, getting back to this point that Elena was making, and the question about institutions and so forth, we want to know, going back to kind of the Biden administration, the Trump administration, everyone's sort of trying to think about John's question: is it worth thinking about incentivizing capital flows to flow to poor countries to invest in infrastructure? If the return differentials are 2x, given that there's no current tradable instrument for roads in Kenya, and you have to think of all the work that would go into thinking about how to create that, plus the required differences that rich country investors might require because of the political risk and other things that are talked about in the paper, 2x may not be big enough. And so if the differential is really 2x, in countries where that differential isn't very big, it goes back to the fundamental points that in those countries, it's not really worth having a conversation about how to create tradable instruments. It's like, think about how to fix your domestic economy, how to create the right institutions to actually generate a situation where those returns are actually big enough to be interesting. All right. And so I think the framework in this paper is useful, predicated on the World Bank actually producing updated data, for us to be able to gauge where in the world are the infrastructure returns that are not being manifested because of this frozen capital problem, and are they big enough to matter?
I'm just
Yes.
curious, why is there, you seem to have a bimodal distribution of opportunities here. Either
Yes.
it's a huge return or it's a negative or zero return. How come we don't have a hump in the middle there on the borderline? I'm just curious as to why the data falls out the way it seems to.
It's the right question. I don't know the answer to that question.
I was expecting a plot where countries are on the.
Yeah, that would be worth doing. And
I don't think it is bimodal. What you said is it's 7x conditional on being greater than 1. And that's completely consistent with a normal distribution.
This is the conditional.
But the fact is, it's not 7x everywhere. It's 7x conditional on its greater than 1.
Yes, that's right.
So that's perfectly,
That's
that
right.
just means we have a normal distribution out there.
Yeah, I don't know whether it's normal or not.
I don't know if Paul's fact is.
No, that's a fair point. That's a fair point. I guess the general point is there's wide variation. Right.
In these estimates.
In these estimates, we have a section of the paper where we kind of talk about whether these numbers are even plausible. We think the counting methods estimates are plausible, but they're still very, very variable. I think they're very, very variable. They're very variable for a lot of the reasons that we've alluded to.
You could say it's 20x in the country where it's biggest.
Yeah.
Yes.
Question over here.
Yeah.
Peter?
Yeah.
And perhaps this is an idea for a follow-up paper. It's really nice that this data is in 1985, in part because you could take this and say, could we use this to predict where China saw the most opportunities? And so where did China actually enter? And did China invest in infrastructure, in roads versus building out the grid? And then moreover, look at the terms of agreement between China and the African countries to say, like, how much surplus was generated and like what did China hold as collateral? So for example, in Kenya, like China's holding the port of Mombasa in order to create the highway between between Nairobi and Mombasa, right? They also have roads in Jamaica, but like in the Bahamas, for example, like China does not build any of our infrastructure. And so this could actually be pretty useful for kind of like predicting where China emerged and kind of like filled this gap. And so maybe that's a subsequent paper.
Not just China. We have a prediction made in 1985. So let's look at who built roads
Yeah.
one way or
No,
another,
so-
and how'd their GDP come out
Exactly.
one way or another.
So to that point, we actually look at this just very qualitatively for India. So it's interesting. So India does not fall into quadrant 1 in 1985. And what do we know? We know in 1982, India experienced a growth acceleration, largely because of domestic reforms. Okay. But ask the question, it's natural to ask the question, did they do a bunch of infrastructure investment? It turns out that actually India was not in quadrant 1, and infrastructure with a 5-year increments following 1985 actually declined it every 5-year period. So in other words, India grew really much more rapidly post 1992 without infrastructure investment. And again, crudely speaking, this dual hurdle framework would have said, not so surprising because if they didn't fall in quadrant 1 and it wasn't clear, obviously they needed a lot of infrastructure.
What did China look like in 1985? Because China grew, and boy, are they ever building infrastructure.
Yeah. So China's not in quadrant 1.
A lot of people still think they're.
Yeah, exactly. You're right. But the more general point, I think this is the two biggest takeaways from this paper are A, the data. It's criminal the World Bank isn't producing this data and validating it.
How much effort would that take?
They presumably they've got the information because these consultants did it in 1985. I've sent emails to people just I mean, even when David Malpass was here.
Yeah.
This is probably, they've got, I don't know, 25 economists and 50 RAs.
But you would be ready to, this tool analysis, you would apply right away.
Yeah.
You're ready to go.
Because in principle, what you'd want, right? You'd want a website that says this data has been independently constructed and validated, not meddled with politically in any way. And anybody from, Dodge and Cox to Vanguard can go look at the estimates.
But I want to check. These are not data. These are estimates.
These are estimates, yes.
So actually, I would love to see the underlying data.
Yes.
And then make my own estimates of just how
Correct.
you.
So yes, I think you'd want both. You want underlying data, have it there, on the cost of road construction, number of miles, kilometers, all of that. But then I think you'd also want an institution to actually do their calculations, and you can compare the calculations. Let everyone,
There's a danger though, if I mean, it's bad to talk in a room full of academics about why we shouldn't want the World Bank to produce some data, but if they're giving out, this is our
So I think they should.
anticipated.
I think they should produce the data.
I know,
Yeah,
that's what you're, but the danger is if the World Bank puts out, this is our anticipated internal rate of return, this is the anticipated external rate of return, and they're bidding on a contract against something like a China, then China has more complete information, could undercut them, right? And so.
Well, all the better. I mean,
All
if
the-
we
yeah,
want to develop
data.
in the third world, I don't care who
Data.
funds it.
Yeah, just put the data out there, right? And then the point is, if you
This isn't, but back to John,
Yeah.
this isn't just data. This is estimates
Data
They're
and
actually
estimates.
very hard to construct.
Yes, yes,
Because
yes,
the inference problem
That's
is here
from
is
nineteen
enormous.
eighty-five.
yes.
For any
A little
year,
bit of the
whether it's
change in the world.
1985 Or any year.
Right.
I mean.
That's right. So we should the data and estimates. And put the data out so everyone can do their own estimates, but the World Bank should also produce the estimates. And we can argue about it, right? So that's point number one. I'm trying to remember my second point.
The World Bank might find that the conclusions are very embarrassing. For example, Malpass came here. I was
Yeah.
surprised to learn the World Bank is refusing to fund any fossil fuel development. So if you live in Africa and you're burning wood
Yep.
chips and dying of emphysema and you want a propane stove, sorry, we're not helping you. And that might be very embarrassing if you actually put up the data.
That's
on
why you
what
need a
good-
private sector.
Yeah.
So you want,
Or a Treasury Secretary to say, produce the data. The second point, I think, so point number one is more data, produce the data, update the data so people can produce the estimates so that other people can also produce the estimates. Second point is, in general, this framework, we've applied it to cross-country data, but you can apply this within countries. I think Michael, I don't know if Michael's still on, but Michael made this point earlier, right? If you want to understand at the margin whether you want to invest in schools or roads or electricity versus roads or bridges, you could do these estimates, right? And begin to rank order the social return to projects in the countries.
Well, Steve, it's not that easy. So the Inflation Reduction Act recently came.
Yep.
And within the US, it was claimed this is going to produce manna from heaven and growth and all the other stuff, or it might be money down a rat hole. Who knows?
Claiming is the World Bank is very different than actually estimating. And having some, it's just why I think it's so important, some independent body, right? To say, these are all our assumptions, this is what we did. You decide if you like it or not, right? But put it out there. It's because your point, more data is helpful, right? Because if you're trying to, what seems to be clear is there are probably some places in the world, right, where they're in principle the social rates of return are high enough to have a serious conversation about how you would actually create tradable instruments in the right political climate and so forth. But in order for that conversation to go anywhere, people need information. And a way to sort of internalize those externalities, if you will. And that's kind of the World Bank's, that's kind of the raison d'etre. They're not producing the data. I think it is embarrassing, frankly. So,
Also understanding the economic and econometric premise of this analysis would help us be more confident in the use and quality. So they are very hard to.
yes. So I point you to the Koenig and Nathan paper, and there was also in the Growth Commission that Mike Spence led in 2008. There were a series of papers on infrastructure, and Marianne Fay, who's cited in this paper, there's one of the papers that's cited in the references here, did a kind of a deep dive looking at all the various econometric problems with actually estimating rates, social rates of return, and they sort of conclude that these are surmountable problems if people are serious and careful. And there, I didn't want to. There's a lot to talk about without getting into the details of the econometrics, which isn't my comparative advantage. But there's a large literature that's
But
quite
I'm thinking,
seriously.
I'm sure that there are economic assumptions built into it, but from an econometric standpoint, if it is a production function estimation, our understanding of measurement error models has changed so much that it would be nice just to repeat within
Absolutely.
their own economic model, different
I agree with you 100%.
econometric setup.
And again, all the war criminal.
But they are resistant. That I understand. They're very resistant.
Well, then I think it's not just the World Bank. They're not even thinking about it.
You're pointing to a larger thing that, well, correct me if I'm wrong,
Yeah.
it strikes me at the World Bank and the IMF and other institutions, that no one does any evaluation of are we doing any good? It's how much money did we spend?
Exactly.
It's not, are we doing any good here?
Exactly.
That's ridiculous.
Are they doing any good? Well, that's kind of a hard thing to figure out.
Projects we funded last year. I mean, let's start with the roads we've been funding for the last 50 years. Are they still there? Are they full of potholes? Are we doing any good here?
Yeah. And again, to the point, I mean, when you kind of focus just on these financing gap questions rather than rates of return, it sort of begins to push you down a very dangerous path. So bottom line here, so let me just say, Nick, please.
Let's go.
Okay, well, please.
I mean, I did an awful lot of power projects, an awful lot of road projects, all over East Asia primarily. Every one of those projects, after it's completed, the completion report is then evaluated independently by what used to be called the Operations Evaluation Department. The rate of return is compared with what was projected in the project, and they saw what was the rate of return subsequent to the project. Most didn't meet the predicted rate of return, and part of the reason for that was the delays. The fact that there are all sorts of things that slowed things down, and that tends to depress the rate of return. But the bank, got to be fair to the bank.
That's true. That's true.
They've analysed this up, down, around the town. The amount of navel gazing that was going on in the institution to try and determine whether or not these projects made sense for the countries was probably excessive by any reasonable definition. And of course, don't forget that from 95 to 2005 or 2010, infrastructure in the bank was a bad word. Poor old Wolfenson couldn't get the Latin America, the middle income countries to borrow from the bank on the bank's rate of return because they no longer wanted to do infrastructure projects. If you wanted to borrow for gender equality or, you know, helping the really poor people, which all should have been done through IDA accounts and others. But I mean, there's a massive amount of work gone into this. I mean, in 1985, I was advising the Chinese government on foreign borrowing policy. The per capita income was $300 per head was the GDP. What interested me in this quadrant in 1985, according to this data, what were the sort of beneficial pairs? Could you tell us 2 or 3 countries that were developing countries that crossed the bar?
Yes.
And 2 or 3 of the potential funding countries where the private rate of return domestically was low enough that these developing countries would be an attractive alternative.
Yeah, so the countries that actually fell into quadrant 1 for both roads and electricity in 1985 were Argentina, Bolivia, Honduras, Indonesia, Kenya, Malawi, and the Philippines.
In one.
Yeah.
That's in one.
That's in quadrant 1. Those,
Argentina.
yeah.
But these after action reports, I didn't know about this. This is a
Yes.
fantastic source of data.
That's amazing.
Yeah, we know what all the
It's
past
every
projects
year.
rate of
It's
return was.
released every year.
I feel a
There's
little
ton
bit
of data.
I feel a little bit careful because so the Nick's right. They roll back and then there's some citations in the paper to some of these independent evaluation papers.
By the way, the fund has the same deal.
Yeah.
Monte Carlo ran it for quite a time.
They have their analysis exposed is on specific projects. It's not aggregate, right? Which is okay, but it's just it's answering a slightly different question.
Hey, Rick, can conclude.
But anyway, to be
You want to
continued.
a final word?
So thanks for listening. The papers come out. Will be out in the JL at some point. I don't know when they're going to get around to publishing it, but comments welcome because we think this is a bigger long-term research project.
For sure.
Yeah.
Thank you.
Thank you.